Symbotic is a warehouse automation company that includes some of the largest customers, which are Walmart, Target, and others that are trying to automate their warehouses to lower the cost to serve customers. Symbotic shares are soaring recently, and they're up over 50% year to date in 2025. Of course, I'm happy about that because I've recommended Symbotic stock as a buy all year long here in 2025. And I'm going to update that recommendation here and let you know if it's too late to buy this stock or if long term investors can still jump in and receive excellent long term rewards. Let's evaluate this interesting AI robotics company.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So like I shared with you in the introduction of the video, I've had Symbotic stock rated as a buy all year long, and I last updated that recommendation on March 4th, 2025, reiterating to investors that I still believe this business was a buy in March. So since then, the company reported quarterly financial results, and that was for the quarter that ended March 29th, 2025. The company's results for that quarter came out about a month after the quarter ended. So I'm getting this data from the company that you're seeing here on this chart that aggregates all of this data and saves me a tremendous amount of time, and it's fiscal.ai, which is a website that aggregates a lot of financial information. So the total revenue for Symbotic increased to $550 million in the most recent quarter, and that was up from $393 million in the same quarter the prior year. Now, in following this company, the major constraint it faces is the time to implement. It already has a large backlog of orders. Customers already have ordered their services, and it's a matter of how quickly can somebody go into these warehouses and automate them. And so that's what the business has been trying to improve on over these last few years is the time to implementation, the effectiveness of implementation, and they've been getting better. So in addition to increasing revenue, they're increasing their profitability. Gross profit jumped to $108 million, up from $30 million in the same quarter last year. And their operating losses improved from $65 million in the same quarter last year down to $32 million in the most recently completed quarter. So while its operating losses are still negative, the company's free cash flow is positive and improving. For the 3 months that ended March 29th, their free cash flow jumped to $249 million. That was up from $197 million in the same 3 months ended December 28th, and up significantly from the same 3 months that ended March 30th, 2024, which was only $18.2 million. Of course, the company's cash flow from operations are a lot different because of the timing of payments it receives from its buyers, right? When it receives an order, sometimes it receives the cash flow up front, sometimes it receives the cash flow throughout the timing differences on different times it executes the build out of those automation of the warehouses. So depending on the contract and depending on the terms will determine when it receives cash, but it has a significant backlog of orders like I mentioned earlier. Okay, so now that we looked at the company's recent performance, let's take a look at the valuation that the stock price has experienced after the big increase in share price. So there's a difference between the market price and valuation. And valuation takes your market price and divides it by some valuation metric like free cash flow or earnings per share, and it measures what you're getting in return for the price that you're paying. So for Symbotic, the valuation has increased. It's now trading at a forward price to free cash flow of 39, which is up from the forward price to free cash flow of around 27 it was trading at earlier this year. So I've also calculated my proprietary discounted cash flow valuation for Symbotic stock, and the intrinsic value per share I calculated for this business is $23.66. The current market price is $35.70. So when measuring by my discounted cash flow valuation model, the stock price does look overvalued following the huge increase in share price improvement this year. But when we went to fiscal.ai, which is where I get nearly all of my financial information, the valuation at a forward price to earnings of forward price to free cash flow of 39 doesn't look overvalued. In fact, it still looks undervalued based on this valuation metric because the business is growing rapidly. It has a strong backlog of orders, and the industry is moving in its direction, right? The rising cost of goods sold, the labor shortages, which is getting worse, and the increasing spending from consumers shopping more online versus in person. It all favors this business, so it deserves to be trading at a premium valuation, but it's trading at a relatively inexpensive valuation according to this valuation metric. So all that being said, is Symbotic stock still a buy at current market prices? I think so. I think even though the price has increased by so much, I think the tailwinds behind the business are so large, and the partners that it's working with, including Walmart and Target, are investing so much in these capabilities because they need to in order to compete with Amazon and other retailers. And so the growth in their business, I suspect, will continue for not just a few years, but perhaps a few decades. And I don't see that trend of consumers spending more money online ending anytime soon. And so that's going to be a further tailwind for this company. So I'll update this recommendation today, June 18th, 2025, to reiterate the fact that I still believe this business is a buy.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.